I'm Bart Smets. I'm Head of Insurance and Risk at Umicore in Belgium. Thank you for attending this virtual workshop. Throughout the sessions, you will have the possibility to ask questions, and at the end of each of the presentations, we will present a polling question to which the audience can vote. This may be a virtual session, but climate change is far from being virtual. It is happening today. We are witnessing a higher frequency in severe tropical storms, longer drought periods, and large wildfires caused by them, rising water levels, and more natural catastrophes than ever before. How are these events impacting organizations worldwide? And more importantly, how can risk managers address this challenge today? FERMA's most recent European Risk Manager report shows that only 27% of the risk managers already is, and another 13% is planning to play a specific role regarding environmental, social, and governance-related risks in their organization. The two main obstacles for risk managers integrating ESG into the risk management process today are the difficulty of qualifying sustainability risk. What is the impact on corporate exposures over a period, let's say 10 to 20 years? And secondly, the limited knowledge of those risks. So today, risk managers feel that they are not sufficiently equipped to address these risks. But even more worrying is that a large number of the respondents indicate that there is a lack of support from the board and top management, while the Global Risk Report issued by the World Economic Forum indicates that environmental risk is now one of the top concerns for risk managers. Today's workshop will provide you with a future look on climate change and how this can or will impact organizations in the next 10 to 20 years. It will also focus on solutions that companies already adopted and which are available through insurance solutions. And finally, we will show how technology can assist risk managers, insurers, and other stakeholders in assessing and addressing these risks. Joining us today are four interesting speakers. The first session or first presentation will be given by Stefano Bonelli. Stefano is a partner at ERM in Paris, where he's in charge of ERM's climate change services for Southern Europe. He advises clients to improve their sustainability performances and develop and implement effective strategies to deliver value through sustainability. Second speaker of today is Rob Bailey. Rob is Director of Climate Resilience for Marsh & McLennan, and prior to this, he was Director of Energy, Environment and Resources at the think tank Chatham House, and he also led climate change work for a major international NGO. Third speaker today is Antoine Denoy, who joined the AXA Group as CEO of AXA Climate, following a career at Google France. And he has also published several books, including Big Data, Smart Data, Stupid Data. To him, parametric insurance is the best space to combine data, technology, and protection. Final presentation today will be given by Gianluca Ferrari, who has been working at Radar Meteo in Italy as meteorologist. After an initial period of operational activity in weather forecasting, he has specialized in the development of specific services for the insurance world. As insurance and agrometeorology manager, he coordinates the weather data analysis activities for applications in the insurance field, supporting loss adjusters and the development of parametrics in Italy. So, Stefano, what projection can be made over a 10 to 20 years period, and what are ERM's conclusions and takeaways?
Thanks, Bart, for the introduction. Good afternoon to everyone. So indeed, the idea is to present now what is going to happen or likely going to happen in the next 10 to 20 years, and also providing some insights on how to handle the situation and manage. Before entering into various, I would say, elements of resilience. Just a brief introduction on ERM. So thanks, Bart, for presenting me. As for the company I work for, ERM, Environmental Resource Management, we have about 25 years experience in the sustainability space, EHS and sustainability. We are currently a bit more than 5,000 consultants globally, working with essentially the major global organizations across all continents. We are present in I think 30 with more than 160 offices. But I would say our core work is really sustainability and EHS. That's what we have been doing for the last 45 years, 25 in France, where I'm sitting. Right. Didn't want to spend too much time presenting ERM, so let's start directly with the core of today's topic. Before entering into the impacts of climate change, the hazards, how climate change is going already to probably impact activities, and it will be even more so in the decades to come. I just wanted to provide an overview of the situation, essentially through the IPCC lenses. So the group, the Intergovernmental Panel on Climate Change, which is gathering all the scientific knowledge and publication related to climate change, the physics of climate change, but also the impacts of climate change and plans for resilience. So what you can see here in the slide, in the screen, is the evolution of global temperature since the pre-industrial age. What the models and the observations are telling us is that global temperature on average has already increased by more than 1 degree Celsius at the global scale. And models are telling us that it's going to increase significantly unless we curb our emissions. And this data point is quite important. I suspect that most of you have heard about the 1.5 degree Celsius threshold that we shall not exceed, and the 2 degrees embedded in the Paris Agreement. Why these numbers? Why 2 degrees Celsius? Why 1.5? This is essentially a precaution threshold not to exceed, as pinpointed by the scientific community, to avoid, I would say, the most catastrophic effects from climate change. Unfortunately, we don't have much time here, but if we exceed those thresholds, it is going to be very likely that the climate system will go into a set of feedbacks that we are not so well equipped, let's say so, to manage and to handle. So 2 degrees Celsius is really what we shouldn't exceed, but the scientific community is actually revising that number and has put forward the 1.5 degree of average global increase not to exceed, to be, let's say, relatively on the safe side, which will enable us to limit as possible the largest impacts of climate change. There will be impacts, there are already impacts, but if we stay below 1.5, we can probably manage, we will manage the impacts of climate change. Now, to get there, we need to change substantially our economies and the way we live, we work, we do business, we act as citizens. Essentially, you see here a blue arrow, which is indicative, but not so much so. Pretty much the steepness of emissions we have to do to generate to limit global warming to 1.5 degrees. To try with next elements. So it's really important to limit global warming. We have to act now. Of course, there are risks. There are opportunities as well to capture in this climate change, energy transition. But the other message is, if we exceed 1.5 degrees Celsius, there will be significant impacts from climate change. But even if we don't exceed that, there are already impacts of climate change from climate change. Now, next step is, what are these impacts of climate change, and what are we going to see in the next 10 to 20 years? which are also called the decades of action. It's really now that we need to, on the one hand, mitigate, reduce climate change, but on the other hand as well, build resilience, which is really the topic of today's conversation. Now, the impacts of climate change are specified. I don't know if you see the slide. I don't see. Okay, no, that's too far. Yes, this one. The impacts of climate change. You probably have heard about the TCFD, so the Task Force on Climate Financial Related Disclosures. As ERM, we were mandated to develop the guidance, the technical document on how to carry out scenario analysis to assess and appraise the impacts of climate change in future over a medium to long time frame period. The impacts of climate change are essentially around four main pillars. Direct impacts from climate change, physical climate change, transition impacts, impacting market conditions, profitability, new markets, new products that are going to be favored in the context of energy transition, or other that will become obsolete. Third pillar is legal liability, and the fourth one is around reputation. Is a company, is an organization aligned or not with what is requested to do in terms of energy transition? So we have four quadrants of impacts. Three are indirect, transition drivers, legal liability, reputational issues, and one is direct, the physical impacts of climate change. All these indeed impact businesses in various ways in terms of both commercial and impact in terms of increased operating costs, for instance, carbon taxes, new regulation on carbon, capital upgrade requirements, needs to build resilience to protect physical assets, market demands, price shifts, so increased demand for batteries to support the transition to disruption versus thermal disruption through physical climate change, through I would say supply chain that becomes less competitive, stranded assets, assets that are no longer profitable and that needs to be dismissed in the context of energy transition, and so on. So these are the impacts, and as you can see today, we are really focusing on the physical impacts, the direct impacts from climate change. Now, how to do it? How shall we handle this situation? How can we face this, and what are the solutions that are available? And what will be the physical impacts of climate change? So essentially, in climate change modeling, when we look at the impacts of an hazard, we consider different categories: flooding, water stress, water scarcity, heat stress, increased temperatures. Fire modeling is another one that is driven by essentially less precipitation available and increased temperatures. Storms and cyclones, essentially how the whole climate system will evolve, and what can be the impact of climate change on an asset, on a location, on a site. Now, what you can see here is a map from a project that we have recently completed for a major bank in the Netherlands, where you can see what are going to be the projected impacts of flooding events across the whole of the Netherlands, which you can overlay to the zip codes or the location of physical sites and assets to try and understand what are going to be, again, the impacts in this case in terms of potential flood on an organization. It is quite important to use high quality data so that you can really get a good understanding of what are going to be the likely impacts, and also to consider, in this case, for example, very relevant for the Netherlands, what are going to be the changes, the upgrades in flood defenses, for instance. So through these tools, climate change modeling, you can grasp and get an idea of the potential impacts in future up to 10, 20, 30 years in time. So these scenarios is up to 2050. Of course, it's a long-term scenario, but it enables us to include that forward-thinking element into planning, into building resilience, investing on a new business, planning a new activity. And then also it's a first action plan. So how to do it? Once you've done and you've taken the climate change models, so you have different sets of data sets available, scenarios. Typically we use IPCC derived climate change modeling, and then we can apply the projected changes to physical climate change into the future, add the location of an asset, a site, and then come up with a ranking of how that specific asset, how that specific facility site is facing climate change in terms of risks. Is it exposed to important impacts from climate change, or is it only moderately exposed to climate change, or not at all? So we can classify the different assets, do a hotspots analysis, screen across a multitude of facilities, the few or the some ones that are exposed to climate change, and from that build a resilience plan. So look at the site more precisely, understand what are the barriers in place, the mitigation, the adaptation measures in place, what the site is doing to enhance resilience, and if not, what can be done to enhance resilience. So my message would be here, we really need to, and as Bart has mentioned before, we are at the beginning of that, but we really need now to add that additional forward thinking, look into the future, to consider climate change as most of the other risks from a business perspective, like a stability of a country, the projection of market increase in a given geographies, and so on. So climate change has now become, and it is more and more, a key element in defining sound, robust strategy, but business strategy. And it is key to embed resilience from the beginning, with that forward thinking into the future. Also to plan the next activities, investments, and grasp also the opportunity from, but that's more on the transition side, that lays ahead of us in terms of transition. Yeah, I'm conscious of time, so I think I'm over with the time I'm allowed to present this. But yes, that was the message I had indeed. There are tools. We are facing a challenging moment, as you all know, but there are tools that can help us navigate through the risks. And it's very important to use them from now to build new solutions to enhance resilience and define robust action plan based on scientific data and I would say, and data validated sort of information.
Thank you very much, Stefano. We have a question regarding the data. So the question is, what are the data used for the modeling of physical risk? Can you shine your light on that one, please?
So again, it really depends on the resolution of the scope of work you're looking, but simply put, what is used are the scenarios from the IPCC. So the RCP 4.5, 8.5, and so on scenarios, business as usual, a world at 2 degrees Celsius. Next year, there will be the new data sets from the IPCC coming out. But to keep it simple, we start from a baseline data point, the situation as it is today, and then we use the projection from the buckets of model from the IPCC, that represents the recap of the likely climate changes, as seen from a bucket of models and used by the scientific community, and we run those future scenario modeling. So IPCC datasets. For the baseline, you can use various datasets depending on what you're looking at. A good data set for a baseline are the data sets from the WRI, World Resource Institute. If you're looking at flood events, for example, you can also use other data sets. For instance, if your US is providing good data point, but it also depends on the resolution. If you are very local and you're lucky to be in countries like the Netherlands, you have plentiful of data sets available with very high resolution that forecast what are going to be the changes in flood, for example, events across the whole country. But I would say at the global level, IPCC, for specific geographies, you can go down to a bit more granular information with local country level data sets. And these are available up to 2050 and beyond, at least the IPCC.
Thank you. I think we have time for one additional question. Can you give us examples of countermeasures to be implemented by an organization with an asset that's exposed to physical risk? And that's perhaps one that also Rob and Antoine can comment, but I would first like to hear Stefano's view on that one.
Absolutely. So one of course is work with the insurance world, but that's for Rob and Antoine to provide more insightful, I would say, information than me. What I can do is bring I would say an engineering perspective, assuming the client is an industrial company with an industrial site. The measures are really resilience measures. A simple example is a more, I would say, a larger drainage system. If you are in a site that is prone to flooding, as simple as it can sound, the drainage system within the site is a key resilience element for the facility. So if it has been dimensioned considering the flood, a flood with chance of occurrence once every 100 years, but we see that based on projection, that is going to be the normality. Upgrade the design of the drainage facility at the site. Other measure can be installing, for example, additional reservoirs. If you are in an area where water stress is going to be an issue, go for closed loops in terms of the water resource, which in many areas are going to become more and more scarce. So depending really on the hazard, but it's going down to, I would say, engineering solutions on the one end, the ones I just mentioned. There are many more, of course, but I would say the engineering solutions to support resilience and enhance resilience on the one hand at the field level, at the site level, and on the other hand, the management solutions, the business solutions to ensure business continuity, and the risk management measures, which are more your field, the field of the insurance world. So I'll let Antoine and Rob more inputs on that. I wanted to set lights on more the engineering, I would say, elements that you can build, your clients can build, and of course there is also the risk management solutions that needs to be developed or actually are being developed now that will hopefully become the more and more common and more mainstream.
Thank you, Stefano. So those are indeed the more physical engineering and planning related measures that you can take as an organization. I think indeed that Rob and Antoine will be able to elaborate on other measures that can be taken through an insurance or alternative solutions. So, so Rob, how do you see organizations anticipating to this evolution, and what type of solutions can be offered by the insurance industry?
Thanks very much, Bart. So my presentation will hopefully answer some of those questions. just to say a little bit about Marsh & McLennan. It's an integrated professional services firm for companies, Marsh, Guy Carpenter, Mercer, Oliver Wyman, serving clients in 130 countries around the world, specializing in risk, strategy, investment, and people. So climate change is cuts across all the various aspects of our businesses. And Bart mentioned in his opening remarks the Global Risk Report that we publish each year in partnership with the World Economic Forum. And very simply, what we've seen over the last decade or so is that climate-related risks have dramatically risen up the rankings in terms of both likelihood and severity. So on this chart, you can see that as we go towards the present in time, we see essentially that the chart's becoming more green, i.e. environmental risks are becoming more important. And this really is a result of lived experience. People are seeing more climate-related disasters, be they wildfires or floods. But it's also in the observable data. This is data from Munich Re's Nat Cat service, and the dark blue line shows climate-related natural disasters. The light blue line shows non-climate related natural disasters. So there's clearly a climate signal in the reporting data here. And this has an implication for risk. So this map shows return periods for flooding events in Europe. So you can see here that what was a 1 in 100 year flood discharge in 1960 in large parts of Northern Europe now is something like less than 1 in 50, 1 in 25 year event. So risk is increasing significantly. And this has implications for insurance. Okay, so these are examples from Marsh, his work as an insurance broker in the UK on flood insurance. We're seeing increasing incidences of cover being declined when renewals come due, significant hikes in premiums for flood cover, or significant hikes in the excess demanded by carriers. So what can companies do in order to respond to this challenge? Because it's only going to get worse. I mean, this is where we are now. We've had 1 degree of warming. Currently, the world's on course for something like 3 degrees of warming by the end of the century. And of course, every 1 degree of warming is more damaging than the last one. Damage functions are non-linear. So I think the first thing that's important that companies need to be able to do is anticipate how the risks that they face are going to change under climate change scenarios so that they can make decisions about what they need to do to reduce the risks that certain assets or supply chains face, take strategic decisions about where to locate investment and so on. They need to build resilience where they have particular vulnerabilities, and that may also help them access insurance at better rates. They need to work with brokers and insurance providers to access more innovative forms of insurance to transfer the risks that they retain. And then in instances where all of the above aren't going to be sufficient, we expect to see a greater reliance on public-private partnerships to pool those risks that companies and insurance markets alone are unable to handle. So first of all, on anticipating climate risks, one of the things that we've been doing at Guy Carpenter recently is working with existing catastrophe models to adjust those so that they give a better estimate of how climate impacts are likely to evolve in the future. And the problem that you have with traditional catastrophe models is that in order to model the risk in the tail of the distribution, the extreme events, they go back as far in time as possible with their calibration data sets in order to get confidence about what the tail of the distribution looks like. But of course, the further back in time you go, the less and less and less like the current climate your data is becoming. And so essentially, most catastrophe models are calibrated to a historical climate, which isn't like the current climate and is certainly not like the climate of the future under climate change. And so what we need to do is use climate science to adjust the curves within those catastrophe models so that they give a better approximation of how losses may appear in climate scenarios. And Guy Carpenter's been doing this, for example, in the UK with the insurance sector in response to the Bank of England's insurance sector stress test. And these are the results of that exercise for a flood scenario from the Bank of England's climate stress test, where the Bank of England asked insurers to model increases in surface runoff of certain amounts which would be consistent with expectations for how climate change may evolve in the UK under different levels of global warming. And what you see here is quite significant increases in the average annual loss that insurers might expect, and significant increases in the 1 in 100 year loss. So what does this mean if you're an insurer? This means that you need to be thinking about what does this mean for my property and casualty book over the next 25, 50 years? How will it need to evolve in order for this to remain a viable business for me? But what if you're a company and you're purchasing flood insurance? You need to be thinking about what this means for the costs and availability of that insurance over the next 10, 20 years, because insurance premiums are priced to cover the average annual loss, and the cost of capital, of course, is applied to 1 in 100 year loss. So these sorts of figures mean that the terms of insurance are going to change. On the second point, building resilience, Marsh has been doing a lot of work with its corporate clients, putting in place a full life cycle flood resilience plan consisting of measures to increase preparedness, reduce vulnerability, and enhance risk transfer and monitoring. And this includes, we were talking just now about some of the specific measures that you can take at an asset location to improve drainage, to move electricals up the wall, to put in place materials that are going to be more resilient and robust to flood damage so that businesses can get up and running more quickly, all of those sorts of things, putting in place emergency response plans. But it's really about putting in place a holistic risk management framework that clients can use in order to manage this increasing risk, and also potentially allow them to access better terms of insurance because they can demonstrate that they are actively managing down their risks. On the specific point of insurance innovation, staying with the flood theme, Marsh has been working with a parametric insurance startup called Flood Flash, which places remote sensing flood monitors at locations at flood risk properties that can measure the depth of a flooding event. Flood Flash will agree a parametric insurance contract with the client, which will pay out if the flood exceeds a certain trigger threshold. And the advantage of these sorts of products is that you get an immediate payout in effect. And if you're a business that's wrestling with business interruption as a result of increasingly frequent climate events, that means an awful lot. The great thing about parametric insurance is that it can really be tailored to all sorts of different applications as long as the data is there with which to calibrate the product. So we've also been involved in putting in place revenue hedges for weather-sensitive businesses. The first one is a waterways logistics company on the Mississippi River, which was vulnerable to drought or flood along the Mississippi, meaning that the river would become unnavigable. So we put in place there a parametric product that paid out in the event of water levels falling below a certain level or rising above a certain level. Another example was an aeroplane de-icing company, which of course is becoming increasingly exposed to increasingly mild winters as a result of climate change. And there we've put in place a parametric revenue hedge that provides protection against mild winters. The last point I want to make really is that what happens, in the event that all of the above aren't going to be sufficient to deal with the risks that climate change is presenting. And in certain locations around the world for certain types of hazard, we are going to see insurance and traditional risk management approaches fail to be enough. So you can already see this happening, for example, in California with wildfire. In the UK, the government and the insurance sector agreed a risk pool for flood some time ago now, Flood Re, the purpose of which is to spread the costs of what would otherwise be effectively uninsurable flood risks at certain places in the UK across the larger country. And what we would expect to see now is that as climate change increases the risks of certain perils in certain parts of the world, we're going to see an increasing reliance on these sorts of public-private partnership structures to pool risks, spread the costs, and ultimately prevent these sorts of risks ending up on the balance sheets of governments who inevitably end up stepping in the event that private insurance markets are unable to do so. Oh, sorry. So first point is that climate change means that many natural catastrophe risks are going to increase, and in some regions in the world this means that traditional insurance solutions may no longer be viable. This is likely to increase the need for public-private partnerships in those sorts of situations, but in the meantime companies need to think about anticipating how climate change risks are going to evolve, particularly for key assets and supply chains. They need to invest in measures to build resilience, and they need to explore alternative insurance solutions where it's appropriate to do so. Thank you very much.
Thank you, Rob. Very interesting. You mentioned in your last slide already the recent wildfires in California. And earlier this year, we had the wildfires in Australia. Do you know if any of these events were on the map of any of the insurers or reinsurers?
When you say on the map of, how do you mean?
Either their risk map. So did they take them into account when doing their risk analysis, risk assessments?
So the insurers and the reinsurers were aware that climate models were predicting significant increases in wildfire activity, particularly in the Western US, Australia, other parts of the world, Southern Mediterranean, parts of Canada. All of these are identified in the models. But what has surprised the markets is the extent to which, particularly in the Western US, wildfire activity suddenly shot up 2017, 2018. You know, we saw losses of tens of billions of dollars, which kind of, you know, transitioned wildfire risk from being something, you know, a sort of an attritional kind of risk in the body of the overall natural catastrophe distribution that reinsurers are managing, to something that was really pushing out into the tail. And so the nature of wildfire risk as a natural catastrophe has seems to have shifted very rapidly, and this is almost certainly as a result of climate change. The sorts of events that we're seeing are pretty consistent with what models are expecting. So in that sense, the switch happened, I think, a lot faster than many in the insurance markets were expecting.
Thank you. A second question is to know if you see from organizations a more proactive approach in a way that they are taking more precautionary measures, making sure that they are becoming resilient rather than having recourse to insurance solutions or transferring their risk to third parties. Do you see a shift towards being more proactive than before?
Certainly are seeing that, for example, in the UK. With respect to flood, and you know, I don't think this is necessarily a result of businesses becoming necessarily more informed or better informed about the climate science. It's more a result of changes in the insurance terms that they're being offered, which is actually incentivizing them to invest more in resilience and risk reduction measures. And this is a key point actually with private market insurance, is that when risks are priced properly, they can send an important signal and encourage risk reducing behaviors. So, you know, what we want to make sure is that the insurance market is properly pricing in and incorporating climate related risks and providing a price signal to businesses so that they can take the necessary risk reducing measures. This doesn't always happen very well in practice, but I think it's a challenge for the sector to get better at pricing in future climate risks and sending that signal to business so that the incentives are there.
Thank you very much, Rob. We will now be showing 2 polling questions, and then we will continue with the presentation from Antoine. So the first question that we like to ask to the audience is to understand to what extent your activities have already been impacted by climate change. You have the choice between 5 different answers. So you will see a green bar moving on the top of your screen. That's the time left to bring out your votes. And I think we have the results of the voting. So as you can see, there's no clear winner, but I think we can conclude that there are still not many companies that have been impacted very significantly. Although if you take the 2 top answers, so very significantly and significantly, we're looking at 40% of the participants that indicate that their business activities have already been impacted by climate change. Stefano, is that also something that you are seeing in your daily work, or do you see a different different percentages? Stefano, are you still there? I think we lost Stefano. Okay, then I suggest we move on to the second polling question. I was on mute, I'm sorry. So Rob, the results are showing that the half of the respondents indicate that they have seen a worsening of their terms, and another 40%, 43% indicates that they are expecting them to be. So I assume this is also what you are seeing on the markets in your...
That's consistent with what we're seeing, and it's also reassuring to hear that those that haven't actually experienced it yet anticipate it, because you don't want to be taken by surprise by this kind of thing. You want to be preparing for it, and that's the whole point of being able to anticipate how climate change is likely to affect your business. That's why the anticipation component is so important.
Thank you, Rob. So then let's start with the third presentation from Antoine. So Antoine, can you explain to us what AXA's value proposition is, and why did AXA specifically decide to create a dedicated entity like AXA Climate?
Yes, Bart, I can try. You will tell me if I succeed. Thank you very much for inviting us and to have this time about climate change exposure. So I will tell you more about AXA Climate for sure, but more about the key concept, which is the concept of adaptation. Why AXA Climate? AXA Climate is a business unit launched 2 years ago by AXA with a specific focus on climate adaptation. Why AXA Climate at the beginning of the journey? You probably are well aware of this aspect, but the main mandate of AXA Climate is to fill the protection gap. What do we mean by the protection gap? We mean the gap between the size of the climate risk and the level of adaptation and protection of our customers. What is important to say is it's not only protection gap from emerging markets, but also in more mature markets, US, Europe, and Asia, we see many pain points in terms of protection coming from the conventional insurance product. So the challenge of AXA Climate is to revamp our value proposition in order to deliver to the market some new protection offer related to climate. And with climate change, as you have seen sooner in the session, this protection gap will be even bigger in the coming years, in the coming months and years. So there is an urgency to move for the insurance space. What do we want to achieve? We want to achieve more simplicity, of course, in our product. We want to achieve the ability to be faster. We want also to be more affordable, especially for population, especially for emerging markets. And we want also be able, as an insurer, to go beyond insurance and to develop what we call prevention services. What do we mean concretely for AXA Climate and for the market? We mean that the key purpose of AXA Climate is climate adaptation. By adaptation, we mean that given the size and the number of risks related to climate, you cannot only focus on carbon and decarbonization. You cannot only focus on floodings. You need, as a risk manager, to have a bigger picture of all risk impacting your companies. By all risk, we mean risk coming from human resources, for example. It's more and more difficult for large corporates to attract young talents without a strong purpose. By risk, we mean risk in terms of operations. Given the water stress in many geographies, it's important to factor now in your business, in your core business, increase of cost of water and many other natural resources. Risk of finance also, access to capital. When you do not take into consideration climate exposure, it will be even more difficult in the coming years to access the capital. And at the end of the day, there is also a risk on your core business and your product. If your company does not impact, adjust, fine-tune their product to fit new customers' needs, it will be very damaging for the business and the growth of the company. So what do we mean by adaptation? We mean that there is an urgency for the risk manager to have a larger view, a larger picture of all this risk, and to push for what we call adaptation. What we call adaptative business is a business that has climate by design. That means that all components of the business is moving to the same direction, which is to have a better impact in terms of climate. And the question, you have two questions, in fact. How does your business impact climate? And it's a key question for sure. It's about pollution, decarbonization, etc., etc. But the key question is also the second one. How does climate already impact your business? And for us, the main priority for a large corporate is really to be clear about the risk and to have what we call a risk assessment, a macro risk assessment, to be able to fully understand all this holistic risk that is related to climate, and not only focusing on mitigation risk and risk of related to extreme events. What does it mean concretely? We mean that at AXA Climate, we want to go beyond insurance and to provide solutions along the value chain in real time, in 1 year, but also bringing to the market solutions to anticipate climate change and to push for a more efficient adaptation of the company. 3 main and very concrete examples in order for you to understand what do we do concretely. First, we do what we call real-time protection. More and more, we see that because of, thanks to the duty of care of corporates, due to the employees, there is a need for taking a good decision in case of extreme event at the right time. So we have a 24/7 teams at AXA Climate taking care of assets of customers and being able to wake up them at the middle of the night in order to take the decision to protect employees and assets. It's a key one because we are not only doing alerting services, but we are also doing what we call assessment, tasking drones, satellites, in order to be able from the sky to better understand the situation in the field. And you will see that if you understand well what is going on the field through assessment from the sky, you are able at some point of the time to trigger the fair amount of money as a payout. So real-time protection first. Second, of course, parametric insurance. You know well this concept of parametric. It has been described, fully automated insurance contract. So you trigger payout based on weather-related indices. It's a key element to protect supply chain, especially. Why? Because you do not rely anymore on conventional claim adjustment, claim assessment, loss assessment on the field. You can be protected as a corporate against a risk impacting the beginning of the value chain. For example, if you are a FMCG, food and beverages company, you can be protected now against climate impact on the beginning of the value chain, that is to say the production. And the third example, a very important one, is about adaptation. The key element now for you as a risk manager is to be able to say, okay, in 10 or 20 years, what will be the impact of climate change on all my businesses, not only on the protection of assets and employees. And it's an example of what we are doing now in terms of consulting at AXA Climate for one of the largest cooperative in the French market producing wheat. We are able now to adjust and to project the yield of wheat in 10 or 20 years in order not only to be able to say there will be a decrease because decrease of yield because increase of temperatures, but also to be able to be action driven. That means to be able to say, okay, you need to change as a cooperative the way you produce the wheat in order to be able to mitigate the risk and to be better adapted. So action at the end of the day is our key drivers. I just wanted to let you with some key advices based on our track record in terms of adaptive business. First, awareness. I must insist that the maturity of all corporates related to climate change is very low. We have many news circulated from newspapers, but when you want to understand scientific concept, you need to bring scientists inside your company. And the key question is not what does IPCC report is telling you about the global increase of average of temperatures, but the key question for you is, are you able as a risk manager to understand what will be the increase of temperatures in your asset? In the south of France, in the US, in Australia. So to have a local assessment of climate change is a key element, and to be able to succeed, you need to bring awareness and scientific awareness inside your company, not only tools, I would say. Second advice, you should not hesitate, and you should develop a full cross-functions approach of adaptation. Do not only tackle one risk, because you have not just one risk, you have multiple risks. So in order to avoid wasting your time each time, when you need to revamp a process, when you need to change and to fine-tune one key element of your core business, is to take all this risk in a holistic view And that's what we mean by adaptation, going beyond only nat cat risk. And at the end of the day, it's easy to say, harder to do, but it's a key element of success. Put the business in the driving seat. I think if you want to build an adaptative business, you need to change the core business, in fact, of the company. So it's highly connected to the purpose and the strategy of the company as a whole. That means the one also of your CEO. And as a conclusion, I wanted to say that, of course, it's important to be protected, but the key element of success, if we want also to bring opportunities and not only to overcome risk, is to be more adapted. Thank you very much. I hope I did it in terms of 5 minutes.
Perfect, Antoine. Thank you very much.
With my English, Bart, it was okay? You understood?
Yeah, perfect. Thank you. So one of the questions, and I know that I have been saying in my introduction that we are witnessing a higher frequency in severe tropical storms, and apparently also this morning there was another webinar where it was said that it's not so much the number of storms that have increased, but more the severity of the storms. Is that something that you can confirm? That it's mainly the severity and not the number of storms?
It will be very difficult, Bart, not to confirm because AXA Crystal is part of AXA Climate, so I confirm. In average, the global direction is the global message is more intensity, because the higher the temperatures, the more you have water vapor in the atmosphere, and when it happens with a more severe intensity. And in terms of frequency, the state of the art of scientific literatures do not say anything globally. So I confirm Crystal Castet.
Thank you. The solutions that AXA Climate is offering to their clients, is this something that's more applicable to large organizations, or can, let's say, mid-sized corporations also benefit from these solutions?
There is a reality and there is my dream, Bart. The reality is it's more now for large corporates. But my dream and what I want to achieve with my teams at AXA Climate is to be able also to touch the mid-sized companies and also the SMEs. Because when you think of this parametric capability, you can easily guess then this parametric fast payout could be embedded in many other products, including property, including safety product. So what my dream is to be able to build what I call AXA Climate Inside, to be able to touch a larger public, a larger target than only large corporates. But it will be in 2021 or 2022, not before.
That's your interesting business plan. Thank you, Antoine. I think it's now time for launching the next polling question.
Question for you, I think. Maybe it's mine, the next one.
Question is, what does climate adaptation mean for corporates? The 3 possible answers. Let's first decarbonize, and afterwards we will see. Second answer is a bad news for my next property renewals. And the third potential answer is a global and positive transformation across my company, both for our HR, finance, marketing, supply chain. So once again, you have time until the green bar has ended.
Some lobbying, Bart, or not?
We have the answers in the meantime. So I can't see the answers, but it looks like the majority has answered that it's a positive evolution for their organization. So it's good to see that people are really involved and look at it as a positive evolution. Very good. So apparently 67% have answered for positive transformation across the whole company. So not something bad for them. Okay, thank you very much. So we've heard a lot about the solutions, about the forecasts, about how insurers are using data and technology. I was wondering, Gianluca, if you can explain to us how technology can support and assist organizations, being insurers or large corporations, to identify and assess these risks and also become more resilient to climate change.
Okay, thank you, Bart. Good afternoon to the audience. With my presentation today, I'm going to talk about the state of the art of the weather and climate monitoring technology for risk management application. And in particular, I'm going to introduce the concept of precision meteorology, show how data integration can help to build data sets that are useful to risk management application, and how these concepts are applied in a real case with a parametric experimentation that took place in Italy in the last couple of years. So let's start with precision meteorology. And we are facing climate change, as we've seen, and there is an increasing demand of weather data from risk managers and insurance companies. So meteorology is therefore called upon to be a part of a growing number of decision-making processes, and itself assumes a professional connotation. So to answer these questions, innovative solution must be born. Precision meteorology must therefore make use of data acquired with strong technical backgrounds, with consolidated technology and in full transparency to answer this question. Because meteorological data becomes a terminal of a process shared by various actors and enters in significant terms in our life and its quality, in the economic, social and political processes. But there is a fundamental problem with weather data, and this problem is that weather data has its own dimension and dynamics that often do not coincide with those of the system which it integrates. So to achieve the required detail, the integration and merging of multiple meteorological data sources is essential. The precision approach consists in the production and use of meteorological data and their series, both historical and forecast, according to consolidated, defined and shared procedures, in order to set the rule of the games and share these rules between the players of the game. So how we can achieve precision meteorology? We start with observational data. The first step of observational data is conventional in situ weather observation, which are essentially weather automatic station in situ. These are punctual data, which can be integrated with remote sensing weather observation that can provide much more detailed information about the spatial variation of the weather variables, such as weather radar, which can provide an extremely precise information about precipitations. And precipitation are the variable that is the driven of floods and other important calamities. And also other example of remote sensing weather observation are satellite and lightning data. Those data, both in situ and remote sensing, enter a process that is called weather analysis. Weather analysis uses a model, a weather prediction model, that ingests those data and create homogeneous historic weather data sets. This is used to create a homogeneous historical data set both temporally and spatially. So we can produce data sets that can span many, many years, usually 30 to 40 years. The data that is output from their analysis can be post-processed ulteriorly to become even more precise using auxiliary variables such as high-resolution digital elevation models and line cover. The output characteristic of this process is a high spatial resolution dataset up to 1 kilometer, high temporal resolution up to 1 hour, a complete and homogeneous time series up to 30 years with daily or hourly updates, and can produce two types of variables mainly. Basic variables such as temperature, precipitation, and other commonly speaking variables, and also advanced variables such as air probability, extreme precipitation probability, and extreme wind probability, which are, in my opinion, interesting variables for risk management. This is a sum up of the process. So observation data enter weather analysis that its output is post-processed with auxiliary variables to achieve high resolution temporally and spatially. This is an example of an output of the precipitation field of a rainy day in Puglia, a region of Italy. This is the precipitation field retrieved by the integration of both radar and rain gauges data. And you can see that a very localized storm can be depicted very clearly, and you can see how the precipitation is a variable in spatially. So we have a difference in 100 millimeters in less than 5 kilometers, and this is very important to geolocalize this precipitation amount, such as we can individuate the area that is more impacted by the storm. Another example of advanced variable is hail probability, which we can derive it by radar data and lightning data. We have produced an index that can be processed and produce a result that can be expressed such as in number of expected days with hail per year in a country, for example, Italy. This is the example of Italy. The data set is also at 1 kilometer of resolution, so we can individuate the area that are more inclined to these kind of weather events. So let's see how this high spatial resolution weather data set can be the driver of a weather-driven parametric insurance. And I will show you a case study of Generali Italia's Attiva Raccolto Parametrica, which is an agricultural crop insurance that took place, was experimented in the last 2 years in Italy. This is an insurance policy that protects against loss of production following the adverse effects of atmospheric events, which can be recognized based on the deviation of specific meteorological indices. Those indices are critical low temperatures and high temperatures combined with water deficiency stress. So how Generali built this policy? It used our historical data in high resolution for retrieving the last 10 or more years of data to calibrate the parametrics. So Generali wanted to know how the policy would have worked in the past to calibrate it. Then during the campaign, we provide near real-time data, daily updates, to update the outcome of the policy. The data is provided punctually, so every single crop field is monitored, such as there was a weather station installed on the site. We call it a virtual weather station. We provide a flow of data, temperature and precipitation, such as there was a weather station installed on the site. The data enter a crop model, which is provided by the university, and the model quantify completely automatically the damage based upon the weather data that we provide. If certain thresholds are met, generally reimburse the farmer completely in a completely automated way. This is an example of reports that are built on our data and the model, the crop model output. Those reports are made mainly for two reasons. The first is to show to the farmer and the policyholder the past parametric behavior, so he can assess how the policy would have worked in the past year. So, such as 2012, when the critical low temperatures for this location was met in the first days of February and produced a loss of 20% of the crop. In 2019 was monitored near real time, and the output is shown in the first half of the image. So the report is also made every 2 weeks during the validity period of the policy to update the farmer on the ongoing of the policy. And this is the example for the in this index, so water deficiency, stress, and high temperatures for the same location, both in 2012 and 2019. In 2012, also was met both the indices such as the critical low temperature, and also due to a very long period of drought during winter, a loss of water deficiency stress was met and was reported by the policy. So to sum up my presentation, high precision meteorology arises from the needs of the Board of Risk Managers to quantify impacts of meteorological events for activities on very small, spatial, and temporary scales. The integration of meteorological data is essential to achieve this high resolution that we want, but because meteorological scale is not always compatible with the scale of professional application, we have to set the rules of the game, and those rules have to be accepted by various sectors, such as risk managers, insurance companies, and policyholders. And as we see poco fa, in Italy, with Generali Italia, the first parametric policy in agriculture based on high spatial resolution dataset was tested in the last couple of years. And the choice to go on such high resolution dataset is somewhat obligatory due to the characteristic of the Italian territory and high fragmentation of agricultural enterprises. And that's the end of my presentation. Thank you for your attention.
Thank you very much, Gianluca. We will now show the last polling question, and after that one, we will end the session with a few questions to Gianluca and also a general question to the panel of speakers. So let's bring on the last polling question, please. In your opinion, are the historical data reanalysis techniques explained so far useful for taking into account future long-term climate trends? Yes, they are sufficient. No, they're not sufficient or not useful at all. Yes, they are, but they are non-sufficient alone. Okay, interesting results. So there's a majority of the voters, 67% to be precise, that say that they are useful, but they are not sufficient alone. And still 22% think that they are not useful at all. So only 11% thinks that they are sufficient. Gianluca, is this something that you can comment on? Is this, do you agree? Do you have another view, another meaning on the result?
Yes, I agree. I mean, in my opinion, the correct answer is number 3, because they are not sufficient at all alone, because future trend of climate is assessed by climate models. But historical data, in my opinion, is fundamental for the calibration of this climate model, because climate model has a typical drift. So we have to calibrate those models with high quality historic data. Even though historic climate is not the same as we are experiencing today and in the future.
And there's another question for you, Gianluca. It's a twofold question. So what are the sources of data sets used for the weather data as well as for the post-processing activities such as DEM? Do you also use National Weather Station data? And the second part, you mentioned virtual weather station for each crop. May I ask if the positioning of these virtual stations are with respect to land parcels, or is it with respect to grid beforehand considered?
Okay, yes, of course we use weather station data is the main asset that we use to start the process of making those data sets. We use station data and also remote sensing data to combine them and gain more value from them. Also, we use auxiliary variables such as DEM, digital elevation model, and land cover model to do regression and achieve more detailed data. Virtual weather station is a concept that we use to explain how from those data sets that are gridded data sets, we have a 1 kilometer grid data set, so we have a flow of data for every kilometers of the territory. The virtual weather station is the cell of 1 kilometer that is more representative for such as the crop field. So is not a physical weather station; it's a virtual weather station because we link a virtual flow of data that is computed with the process that I shown before.
Very much. So the last question for you, Gianluca. So we've seen that technology and insurance work well together. We've also heard at least part of Antoine's dream. How do you see the future of the technologies you're working with today? Will these become also used in our day-to-day life, meaning that they will find their way into applications for the people like you and me, or will these technologies mainly remain something for larger corporations and insurance companies?
That's a really interesting question, and we are seeing a trend that meteorological data is more and more becoming an interest topic to also common people. So now data is used by major companies, but we are seeing this trend to go to the normal people. So I agree.
Thank you.
Bart?
Yes, Antoine.
There's maybe the technical also key change is really related to satellites. I think we cannot insist more on the importance of satellite images in order to better reduce what we call the basis risk, the gap between the trigger of the payout and the effective loss of the customers. And we are seeing each year new satellite constellations with higher resolution, and the benefits for the risk manager of satellite images go well beyond only the fast payout. So my advice for the community will be to be really careful and close to what happens in terms of satellite images technology.
Thank you for your intervention. So I would like to end this this workshop with a question to all of the presenters. So feel free to give your idea, to give your input. So it's also a twofold question. In European Union circles, at least, policymakers talk about the physical, transition, and liability risks with regards to climate change. This is also what we've heard in Stefano's presentation. The first part of the question is to know if this distinction is helpful to corporates, and the second part, what type of those three risks gives you the biggest worry or concern? So who would like to go first?
Can go if you want, because I like to talk. No, I think it's useful. It's helpful at the beginning of the journey because it brings awareness about different categories of risk. So I would say the distinction is quite helpful for the community of risk managers so far. But what I shared with you, my worry, my biggest worry is just to have a kind of one-step approach. I think that what is important to understand is the fact that adaptation is a larger notion, concept, onboarding all these different dimensions. But if a company move only on physical, only on liability and one step after one step approach, I think it can jeopardize the adaptation success.
I do agree. I think all of these three are important, but for a lot of companies, I also think that the transition risk might be somewhat the hardest one. Stefano, I think you wanted to mention something too?
So, yes, I mean, I totally agree with what Antoine mentioned. To me, what is important is to consider a systemic approach. We need to look at 360. Probably the easiest one to project and imagine is the climate change physical impacts, but indeed transition ones are sometimes challenging to appraise, but material, very material. And they can also generate opportunities as well, which is also helpful in having a more balanced view. But fully agree with Antoine, we need, in my view, we need really to look at 360 in a systemic way to the climate change problem, I would say.
So we've done some work trying to quantify transition risks in banks' lending portfolios, and Oliver Wyman concluded that just in the energy sector alone, just the simple imposition of a $50 a ton carbon price, which isn't especially punitive given the kinds of estimates of carbon taxes that would be needed to get on a 1.5 degree pathway. But a $50 a ton carbon tax could result in credit losses in banks lending to the energy sector of up to, I think, approaching $500 billion, and scaling it up across sectors. Oliver Wyman estimated that there's a sort of a $1 trillion downside of transition risk in banks lending to the corporate sector in a $50 a ton carbon tax scenario. But the thing that keeps me awake at night isn't a physical risk scenario or a transition scenario. It's a kind of an unholy clash of the two. So imagine a scenario in which we continue not to do enough to contain emissions, and temperatures continue to rise and impacts continue to accumulate, and things get so bad that publics demand governments to act. So we've got serious physical risks, you know, and governments are saying, and publics are saying to governments, you have to intervene, you have to get us on track for, you know, a lower temperature future. We can't bear this any longer. And so governments intervene in an ad hoc, chaotic way with very costly, poorly planned interventions, very high transition risk. And we end up with the worst of both worlds. We end up with very high physical risks, forcing governments to respond and push us into very high transition risks. And that's the worst case scenario. And on current trajectories, it's certainly not inconceivable.
Thank you, Rob. Thank you all for these interesting views. And with these closing remarks, we have come to the end of this session. I'd like to thank all of the participants, the audience, as well as the presenters, and wish all of you a pleasant rest of the afternoon. Thank you very much. Hope to see you soon.
Thanks to you, Bart, as a master of ceremony.
But Bart, thanks all.
You all.
Bye.